Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nick Shermans and Aaron Varghese work for Pure Portfolios. Any opinions expressed by Nick and Aaron or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everyone, and welcome back to another episode of Blind Spots. We are nearing the end of the year, which is always a good time to take inventory of your financial life. So today we are going to be talking about some areas of focus that we find most important at the end of the year so that we can wrap it up and start a fresh new year, which I think everyone is ready for.
Yeah, I can't wait for this year to be over. This is more of an abbreviated list, so things that we deem most important. And I can tell you, this list has nothing to do with what the market does next. It takes zero talent to implement this list. This is what we call the low-hanging fruit, optimizing the things that you can control. If you heard me write or speak, we're big on controlling what we can control. I think there's a tendency for a lot of people, especially in an environment like this, the 24-hour news cycle with social media, your friends, to get hyper-focused on things you can't control, what the Fed is going to do, what inflation is doing. And then you look on the back end and you see people leaking oil and you're like, hey, let's turn the mirror towards us. I think 2022 is a good reminder that investing is hard, right? The last 10 years have been really easy. People have been able to get away with a lot of mistakes. Now, this is more normal when you look at the market through a historical lens. And as professional investors and planners, we would do better to assume the next couple of years are going to be rocky, and we can do our part to mitigate damage by optimizing some of these year-end planning tasks.
Yeah, so we just want to make the end of the year as easy and frictionless as possible. The holidays are around, spending time with family, maybe traveling. So it's good to get a head start on these because sometimes it can take some time. So let's kick it off with RMDs, or required minimum distributions.
So Aaron, tell us who has to take an RMD and what accounts do they come from?
So your RMDs come from your pre-tax accounts that are like traditional IRAs or 401ks that you have not paid income tax on yet. And if you are 72 years or older this year, you may have to start taking your RMDs.
And RMDs are taxable, so there's really no way around that. You take the funds out, it's all pre-tax money that is grown tax deferred. You take it out, it becomes taxable. We get a lot of clients asking us ways to mitigate taxes on their RMD. And Aaron, you can chime in here, but one way to do that would be to gift. So if you're going to give to charity, you can use part of your RMD and donate directly to that charity to help reduce your taxable portion of that RMD. The second thing is if you have a financial plan and a comprehensive Roth conversion strategy, you can shrink your overall pre-tax money IRA balances, thus reducing your RMD. Because what the feds are going to do is take a snapshot of your end of year portfolio value for your IRA on 12/31 of 2022, use a factor based on your age to calculate your RMD. So in this case, we would look at 12/31/21 end of year balances, right? So the end of last year, based on your age, they would use those two inputs to calculate your 2022 RMD. If you do a Roth conversion, you're essentially lowering that pot of RMD money, thus reducing your potential tax drag.
Just as a side note, for fun the other day, I was looking at the RMD tables for the calculation, and it goes up to 115 years old. And if my memory serves me correctly, I think the denominator that they use is 2.9 for that age.
Okay, so what does that mean?
So you would take your portfolio value at year end from last year and divide by whatever that life expectancy number is. And
So
that is what you're
divided by
required,
3.
essentially,
So
at
wait,
115
wait,
years
so
old. So
so
he
if
lived
you're
that long.
so if you're 115 and you have $1 million in IRA money, you would have to take roughly 330,000 out of your IRA and pay taxes on a good chunk of that.
Correct.
Wow.
Fascinating, huh? And it ramps up pretty fast. You know, the older you get, the smaller that number becomes.
Yeah, so in general, the older you get, the higher your IRA account balance is, the more RMD that you're going to have. Like that's a good mental shortcut.
Yeah. So
Okay,
anyways,
what's the next one?
So next on the list for year-end planning, this is a great year for it, is tax loss harvesting. Tell us about it.
So tax loss harvesting is basically looking at your non-retirement accounts, so after tax money, and seeing what you have in unrealized gains or unrealized losses. Okay. So tax loss harvesting is only a thing if the market is crazy and if the market is down. So we talk about tax loss harvesting. It really hasn't been a thing over the last decade because the market has mostly been up. But now, if you have a portfolio, again, an after-tax portfolio, a non-retirement account full of mutual funds, full of random stocks that you've collected over the years, maybe you've worked with 4 or 5 different advisors. As you move through life, you tend to collect stuff. You also tend to collect holdings in an account. So it's a really good opportunity to look at what you've accumulated, look at your embedded gains and embedded losses, and to see if you can't sell anything at a loss, perhaps get rid of it and save some money on your taxes. It doesn't feel good to lose money in a year like 2022 and pay a capital gains tax. Okay, so make sure, again, you're optimizing the things you can control, understand what your realized capital gains are so far in 2022. Look at your portfolio to see if you have any unrealized losses to help wash that gain away.
Yeah, so in the same vein, capital gains is another year-end to do, and these kind of go hand in hand, but we often talk about mutual funds in a taxable account and how detrimental that can be for taxes at the end of the year and a surprise for many. So
yeah, and look, the tax loss harvesting thing, any advisor with a pulse should be doing this. So if you're working with an advisor and come the end of the year, you look at your 1099 and you see you have outsized realized gains, that's a red flag. Like you should probably find another advisor because again, in 2022, it just shouldn't happen. Okay. On to capital gains. So I talk about this. You're probably sick of me talking about it, but you could almost set your watch to this. Every new prospective client that we come across and every new client that we onboard, almost without fail, they have a tax problem, and it stems from owning mutual funds, either active mutual funds or passive Vanguard funds in a taxable account that just saddle them at the end of the year with capital gains. Okay, so you, the end investor, are not doing anything. You're not selling the funds. You're not rebalancing. You're not blowing out of any funds and realizing a capital gain. You're simply existing. You're owning these funds in a non-retirement account, and they're spinning off capital gains without you doing anything. It's the most egregious offense and the biggest leak that we see, even for sophisticated investors. Okay, and again, back to my comments on 2022, like the market's down over 20%. Imagine being down over 20% and then getting hit with like a $15,000 tax bill. I can promise you, it does not feel very good. But again, most prospective clients that we come across are doing this year after year after year. And it's such a leak. It's lighting money on fire.
And it can be confusing. I know that it takes some effort to learn and understand how all of these things work, but you will thank yourself for at least asking the question and looking into it.
And don't assume because you work with an advisor that this is taken care of. 90% of our clients come from other advisors, and this is the problem. They've collected mutual funds. They buy mutual funds and just collect them over time. For most of these mutual funds, are saddling them with huge tax bills at the end of the year. So here's your homework. Look at all of your non-retirement accounts, okay, your after-tax accounts. Do you own any mutual funds? If the answer is yes, go to that company's website, go to each fund family's website. So your mutual funds that you own, if you're looking at them on a statement, they'll have these ticker symbols. For mutual funds, they're usually 5 characters long. Go to Yahoo Finance, go to Morningstar, type that ticker symbol into Morningstar, let's say. You should get a history of capital gains paid out for that fund, okay? If you can, sell that fund before they distribute capital gains, okay? If you need help doing this, reach out to us and we can help you. But this is something that we do for clients year in and year out. And many people say, oh man, I had no clue. But it's all right there for you. Everyone has to pay taxes. No one says that you have to leave a tip. And again, it takes zero talent, zero insight into what the market does next to do this.
Beautifully said. Last but not least on our short list of year-end to-dos is double-checking your financial planning inputs. This is everything from your income to your expenses, making sure that your budget aligns with what you are doing.
And I wrote about this, and this is a huge problem. Because think about, again, the last 10 years have been really good. People are used to seeing their portfolios going up by 8, 9, 10% a year. Okay. What subconsciously happens is you build your lifestyle with the baseline expectation that your portfolio is going to continue to go up by 7, 8, 9% a year. Okay. What it equals is a inflated lifestyle expectation, right? You got a tailwind at your back. You're taking money out of your portfolio, but your portfolio is still growing. That might embolden you to spend more money with, again, the expectation that that baseline of your portfolio going up is going to continue perpetually into the future.
It's a good way to put.
Yeah. Fast forward to 2022, you have people assuming the same baseline. My portfolio is going to go up. I can take out money. Everything's going to be great. But when your portfolio is down by 20 to 30%, you're taking an outsized amount out of your portfolio. You can end up in a world of hurt and impair your portfolio to the point where, one, you are never going to recover because you're taking an outsized amount out. Your portfolio is down by 30%. It has to last you for the next 20 years, let's say. You've really impaired your ability to get back to that mark where you were before 2022 happened. And perhaps the most important thing is it's really hard to downshift. If I'm used to spending $150K a year and suddenly things have changed and I have to spend $75,000 a year, it's really hard for people to downshift and do that once they get used to that outsized lifestyle.
It's mentally exhausting. It could be kind of socially damaging and just really hard to stomach. And it's not a fun conversation or realization to come to. So it's been something that's been top of mind for us and a conversation that's been at the forefront for a lot of our meetings. So if that is something that you have not looked into yet this year, that would be a great place to start. It's kind of the basics. And if your advisor is not having that conversation with you, it's time to start the conversation.
Well, and a really quick way to do this is to look at your expenses within your financial plan and what you've modeled for each year. Make sure what you're modeling reflects what's actually happening. So the way you check what's actually happening is you go to your portfolio, you go to your advisor, and you look at what you've taken out of the portfolio on a year-to-date basis. And make sure it's loosely correlated to what you've modeled, because what we see a lot these days is, let's say we have a client that's retired. We model their expenses at $60,000 a year. We look at what they've taken out. They've taken out $150,000 a year. Well, we're not trying to blow sunshine and rainbows for people within their financial plan. Like, we want to model what's actually happening. So make sure you have the inputs correct. Make sure what you're modeling on the expense side is what is actually happening. And if there's a seismic gap, it's time to go back and look. It's time to revisit the budget. It's time to look at credit card statements. It's time to look at your lifestyle and maybe have some difficult conversations.
It's not fun. It's not always easy, but it is necessary. All of these things are great to do at the year end. It is mid-October at the time of this recording, so end of the year will be here before we know it. So if you have any questions about any of the items that we mentioned, you can always reach out to us at insight@pureportfolios.com. And we also offer free portfolio reviews. So if you'd like a professional investor's opinion on your current portfolio, we will give you insight on your fees, tax efficiency, risk metrics, and potential conflicts of interest. Thanks for listening to this episode of Blind Spots. We will see you in the next one.